James. Hi, Steve. Thanks for joining me for our latest market update. To begin with, the war in the Middle East, which we discussed back in April, unfortunately is still ongoing. Can you give me a brief update of what's going on there and the effect on inflation and interest rates?
Yes, so we're seeing a re-escalation. We'd seen a lull following the signing of the memorandum of understanding between Iran and the US, various other parties, but that has re-escalated. So you can see it in the oil price. Brent crude, for example, was about $60 prior to the initial outbreak. It went to about 120 at its peak, just ever so briefly, and then back down. It was back down as low as sort of $70 a few weeks ago, and then the re-escalation has taken that oil price back up to the sort of 90 mark. I think it was around about 100 briefly as well. So currently about 90. So that's the direct impact of the escalation of the war there. That feeds into the oil price, obviously, and the oil price then feeds into, unfortunately, the inflation outlook. So we've had inflation that was substantially above target, sort of 2.8% for a couple of months, back down at 2.6 in the last update that we had. So that was substantially above the 2% mark, but actually it was a bit lower than where the Bank of England feared it might be. So inflation's bad, but it's not as bad as it could have been. But we'll see now where that goes. So oil prices back up inevitably are going to lead to some underlying inflationary pressures from here too.
Okay, is there a risk of sort of second round effects starting to feed through in terms of wage price demand, people asking for more money to cover increased energy bills?
Yeah, there's two elements of this. So there's the initial impact that the oil prices have directly, and then there's the second round effects. Unfortunately, we've got both of those. Ordinarily, the Bank of England wouldn't worry too much about the sort of first round effect, that is to say the oil price, because you can raise interest rates, but that's not really going to impact the oil price. And actually, by the time you've raised interest rates and those interest rates have impacted on the economy, they've sort of filtered through the economy, by that time the oil price could be back down again, in which case you've increased interest rates, which is going to have a sort of negative effect on the outlook for employment and GDP and stuff like that. So the Bank of England tries to look through that sort of first round effect and worries more about the second round effects. So the kind of things that I'm looking out for, which would signal a sort of a buildup of pressure in the second round effects, would be things like food prices. If food prices are substantially above 4%, for example, that would be something that would get the Bank of England's concerns rising. And services inflation too. So if services inflation begins to re-accelerate, then that would be a clear signal that the second round effects are beginning to firm up, which might then require action from the Bank of England's Monetary Policy Committee. In the last iteration of the CPI report, actually food prices were muted and services inflation decelerated slightly. So that's not happened yet, but we've just had this re-escalation and the re-acceleration in the oil price. So we'll see where we get to with those.
Okay, thanks for that. If we put aside the war and the rising oil price for the moment, what does the underlying health of the economy look like?
In the UK, it looks a little bit underwhelming. So you've got employment, which is higher than you ordinarily like it to be. You've got youth unemployment, which is gaining a lot of attention recently. That's because that's in a fairly poor condition. And we've got GDP growth, which is trending at next to nothing from any reasonable perspective. Our expectations have been lowered over the last few years and things, but we really need to see much more growth than we're seeing at this moment in time to be enthusiastic about the UK economy.
Okay. And perhaps given its dominance over global markets, same question again, but for the US.
Yeah, the US economy is in much ruder health. So lower unemployment, higher GDP growth rates. Inflation's just as problematic in the US as it is here, but overall a bit more of you can have a bit more confidence in the US economy. There is talk of if you look at some of the data, it does suggest that there's what people are calling a sort of K-shaped economy. That is to say that the sort of lower end of sort of societal wealth is not doing so well, but the upper end is doing very well. That's the impression you get when you look at the data. But when you look at the sort of aggregated data, it looks like the American economy is in decent shape.
So James, we've had conflict in the Middle East in the background. But how have markets actually performed this quarter?
Markets have remained in very good shape since we last spoke in April. Year to date, equity markets have delivered strong returns. The first part of the year, we saw US equity markets lead the way. And what we've seen since we last spoke has been really a broadening out of those market returns. You've seen the likes of UK, European, emerging markets come to the forefront of equity market returns. The US has still done well, remained in good shape, but it's that broadening out of equity markets that we've seen as of late. That said, that's been very helpful for our diversified portfolios. More recently, we've seen somewhat of a wobble in global tech stocks, predominantly the US mega caps, and that's really a function of equity markets looking more closely at. There's been all this capital expenditure on the AI theme from these businesses. Investors are looking more closely at these businesses in terms of, can earnings really come through from this capital expenditure? What will be being asked to pay for ownership of shares in these businesses? So there's a kind of a reassessment of the valuations on these businesses. They're currently trading at extremely high valuations, so there is room for disappointment if these earnings don't come through. But in terms of portfolio positioning, we do maintain exposure to the tech sector, but it's more of a calculated weighting, maintain exposure there, but not overly exposing our portfolios and investors to those valuation risks. If we then move to fixed interest, the bond markets, we can look at both government bonds and corporate bonds. Government bonds, think of it as being a loan to a government. The yield is the level of income that you receive for making that loan to a government. Now, we have exposure there across portfolios, and what we've seen is upward pressure on those yields. That comes from both interest rate expectations. Markets are pricing in 0.25% interest rate rise, certainly in the US, and also likely here in the UK. That's also combined with longer-term government borrowing expectations. Markets expect governments to borrow more over the longer term, so again, that's added to that upward pressure on bond yields. That said, though, the incorporation of those government bonds within portfolios, the yield that we're receiving is a good ballast, if you like, for portfolio returns. We've then also got corporate bonds. They also offer a yield above that of government bonds, but that difference in the yield still remains very tight. So it isn't enough for us to warrant, say, an overweight position within portfolios, but we're not absent of that exposure. And that's also put us in good stead year to date, also since we last spoke in April, in terms of their contributions to the overall return of portfolios.
Okay, James, thanks for that. You mentioned that market expectations for interest rates have increased. How sensitive are we to that in our portfolios?
We do have sensitivity there, certainly within the bond components of portfolios. But what we have done is limit that sensitivity to interest rate movements. So whether that's an increase or reduction in interest rates, we expect less sensitivity within portfolios than our broad peer group.
So, James, in other news, Donald Trump has introduced a new set of tariffs for US trading partners. What do these tariffs entail, and why is he introducing them now?
Well, what it does do is introduce another layer of uncertainty into broad markets. The way we think about it, though, is this is just a continuation of previously introduced tariffs. From April last year, Trump introduced a series of tariffs. These were very much temporary tariffs, which are now coming up to expiry. So this, again, like I said, this is a continuation. And our understanding is it's baseline 10% tariffs, but ranging between 10 and 12.5%. What does that mean really for risk assets? Well, we've got to look at it in terms of what does that mean for growth expectations, inflation expectations. In very, very simple terms, it introduces the risk of potential for lower growth and increased inflationary pressure. But again, it's very much an unknown at the moment. So in terms of the broad portfolios, we aren't making sizable changes, shifts in our positioning. We are remaining well diversified, though.
And Steve, is there anything you can add from a macro perspective?
Generally, the tariffs are just a continuation of this uncertainty, like James has mentioned already. But we're always going to be in uncertain times. This is just another symptom of those uncertain times. So the general effect that I would expect is that the uncertainty associated with the tariffs, because we don't know if the tariffs are going to be doubled beyond the baseline or even reduced to zero in coming days, let alone in months to come. So you would expect that level of uncertainty sort of suppress some business activity and then have a knock-on effect and suppress some economic growth because of it. And also maybe it pushes up some price pressures. So it might have an impact on inflation. So the general expectation from this kind of activity would be for slightly lower growth and maybe slightly higher inflation. But the uncertainty is the principal element in all of this.
If we bring the focus back to the UK, we of course have a new Prime Minister. My question is, how different is he to any of his recent predecessors? And what might be the effect on the UK economy?
Well, he is a different Prime Minister, and different Prime Ministers like to do things differently. Usually is because the old Prime Minister has gone for a particular reason, so some change is necessary. We know that Andy Burnham is likely to spend more than was broadly expected under a Starmer and Reeves partnership. Andy Burnham's brought in John Healey as Chancellor. That's actually probably a wise pick given some of the alternatives. And we know, of course, that John Healey resigned as Defence Secretary over disagreements about the extent to which spending on defence was being planned. So we can expect a Chancellor who's much more sensitive to the level of defence spending. So an increase in spending, it seems unlikely that increase on defence spending is going to come from a decrease in spending elsewhere. They'll try and balance the books to some extent, but it means that the broader picture is one for increased spending. And the question, I think, on that'll occupy bond market participants is where the money for this increased spending is going to come from. Andy Burnham has sort of committed himself to following a similar sort of fiscal framework to Rachel Reeves, which probably means that there'll be an increase in taxation. And the key question there is, well, okay, the bond market is more concerned about the increase in revenue rather than the level of taxation itself. It doesn't always follow that if you increase taxation, you'll get an increase in revenue. So all of this is yet to play out. We'll see how the bond market watches this. But I guess the main difference is similar sort of policies, but an increase in spending, maybe some different priorities. And it's that increase in spending that's going to occupy an awful lot of debate moving forward.
Thanks, Steve. Thanks, James. That was really interesting.